All right, so we are going to wrap up chapter 1 with what I believe is the most important concept of this entire course. And what is that? Risk management. So you really need to understand how to manage your risk if you're going to be a profitable trader. And if you don't, you're likely heading down a one-way street to wrecked city. And we don't want to go there. So what is risk management? Well, we are constantly managing risk. We're managing it throughout our lives, either during simple tasks like driving a car or making new insurance or medical plans. And in essence, risk management is all about assessing and reacting to risks. Now, most of us manage them unconsciously during everyday activities, but when it comes to financial markets and business administration, assessing risk is a crucial and very conscious practice. In economics, we may describe risk management as the framework that defines how a company or investor handles financial risks, now which are inherent to all kinds of business. For traders and investors, the framework may include the management of multiple asset classes, such as cryptos, or the management of many different cryptos and altcoins. There are many types of financial risks, which can be classified in various ways. In this lesson, we are going to discuss the way these are classified and also present some strategies to help you manage and mitigate your risk. Now, how does the risk management process work? Typically, the risk management process involves 5 simple steps: setting objectives, identifying risk, risk assessment, defining responses, and monitoring. Now, depending on the context, however, these steps may change significantly. So, step number 1, setting objectives. The first step is to define what are the main goals. It is often related to the risk tolerance of the company or individuals. In other words, how much risk are you willing to take to get towards your goals? The next step, identifying risks. The second step involves detecting and defining what the potential risks are. It aims to reveal all sorts of events that may cause negative effects. In the business environment, this step may also provide insightful information that isn't directly related to financial risks. A risk assessment. So after you've identified your risks, the next step is to evaluate their expected frequency and severity. The risks are then ranked in order of importance, which facilitates the creation or adoption of an appropriate response. All right, next step, defining that response. So the fourth step includes defining responses for each type of risk according to their level of importance. Now, it establishes what is the action to be taken in case of an unfavorable event. Monitoring. The final step of any risk management strategy is to monitor its efficiency to the response and events. Now, this often requires a continuous collection and analysis of data. Managing your financial risks. There are several reasons why a strategy or a trade setup may be unsuccessful. For example, a trader can lose money because the market moves against their futures contract position or because they get emotional and end up selling out of panic. Emotional reactions often cause traders to ignore or give up their initial strategy. This is particularly noticeable during bear markets and periods of capitulation. Now, in financial markets, most people agree that having a proper risk management strategy contributes drastically to their success, and I could not agree more. In practice, this could be as simple as setting a stop loss or take profit orders. Now, a robust trading strategy should provide a clear set of possible actions, meaning that traders can be more prepared to deal with all sorts of situations. As mentioned, though, there are numerous ways of managing risk. Ideally, the strategy should be revised and adapted continuously. So here are a few examples of financial risks, along with a short description of how you can try to mitigate them. So market risk. This can be minimized by setting a stop loss order on each trade so that the positions are automatically closed before incurring larger losses. Liquidity risk. This can be mitigated by trading on high volume markets. Usually assets with a high market cap value tend to be more liquid. Credit risk. This can be reduced by trading through a trustworthy exchange so that the borrowers and lenders, or buyers and sellers, don't need to trust each other. Operational risk. Investors can mitigate operational risks by diversifying their portfolio, preventing exposure to a single project or company. They may also do some research to find companies that are less likely to experience operational malfunctions. And finally, systemic risk can also be reduced by portfolio diversification. But in this case, the diversification should involve projects with distinct proposals or companies from different industries, preferably the ones that present a very low correlation. Now, before opening a trading position or allocating capital to any portfolio, traders and investors should consider creating a risk management strategy. Still, it is important to keep in mind that financial risks cannot be completely avoided. Overall, risk management defines how to handle these risks, but it's certainly not only about mitigating risks. It also involves strategic thinking so that the unavoidable risks can be taken in the most efficient way possible. In other words, it is also about identifying, assessing, and monitoring risks according to the context and strategy. This process of managing risks aims to evaluate the risk-reward ratio so that the most favorable positions can be prioritized.
Risk management is the process of assessing, managing, and mitigating losses. This applies to both business and investing. Risk management exists in many forms throughout the financial world. An individual investor deciding to buy low-risk government securities instead of high-yield corporate bonds is an example of risk management. On the more complex side, it can involve trading in various types of derivative and futures securities to hedge against wide swings in investment portfolios. Companies and investors frequently use financial derivatives like options and futures, and strategies like portfolio and investment diversification in order to mitigate or effectively manage risk. Outside the financial world, risk management involves organizing and operating to reduce the potential for accidents, losses, and catastrophes. This can involve anything from managing risk of traveling abroad to designing safe building and products, as well as the most traditional form of risk management, purchasing insurance. Risk management also involves having a plan in place to get things back to normal as quickly as possible if something bad does happen. Marcy holds a high number of stock for Gobble Corp, GC, and wants to protect her investment from taking a loss. One option is for Marcy to enter into a futures contract that locks in the value of her Gobble Corp stock. This way, Marcy is able to manage the downside risk of Gobble Corp's stock value by making sure she won't lose any value should the stock price fall. However, she will also be giving up any gain if the stock price goes up.